Welcome to The Explainer. Okay, today we are going to completely rewire how you look at the stock market. Seriously, I want you to step into a totally new role. Forget being just a passive observer. Today, you're a value detective. We're going to uncover some hidden market treasures, and we'll do it by mastering a very specific application of the Pareto 20% rule. The idea here, based on our source blueprint, is that a mere 20% of your strategic actions will actually drive 80% of your long-term prosperity. So we're cutting through all the noise. We're focusing purely on those high-conviction strategies that the absolute best investors use to find incredible value, right where everyone else just sees panic. So here's our detective's briefing for today. We're going to kick things off with the Pareto 20% shift, then dive into the Dando strategy. After that, we'll look at prospecting and bad news, learn how to conduct real research with the scuttlebutt method, and wrap it all up by discovering economic moats. Let's get right to it. First up, Section 1, the Pareto 20% shift, moving from a fearful investor to an intelligent one. You really have to notice the stark difference between these two approaches. I mean, it's night and day. The fearful investor, they dilute their capital. They're sitting there holding 50-plus stocks, desperately trying to diversify, purely out of FOMO, the fear of missing out. Basically, they're collecting average companies just to avoid being wrong. But the intelligent investor? They do the exact opposite. They practice selective frugality. We're talking about focusing on a concentrated portfolio of maybe just 5 to 10 high-conviction companies. Why? Because they genuinely understand them inside and out. Listen, concentration without expertise, that's just gambling. But when you know exactly what you own, man, that is how spectacular gains are built. All right, moving into Section 2, the Dando strategy, or how we go about exploiting market overreactions. The crucial thing to grasp here is this core paradox of the Dando framework: low risk, high uncertainty. Now, our brains naturally want to assume those two things are exactly the same, right? But they aren't, not at all. What we are looking for are companies where temporary bad news has created massive uncertainty in the market. You know, the kind of panic that causes a stock price to just completely plummet. But if you actually look at the balance sheet, the real risk of bankruptcy or any permanent loss of capital is incredibly low. The business looks distressed on the surface, sure, but underneath, it's fundamentally sound. Which brings us to Section 3, prospecting in bad news. Basically, finding treasures in the trash. To find these low-risk, high-uncertainty assets, our detective work has to start exactly where everyone else is panicking. The legendary investor Peter Lynch was an absolute master at this. He wasn't out there chasing hot tech startups. No, he was looking for what he called blossoms in the desert, finding these gems in totally unglamorous or even outright lousy industries. Take his concept of nukes in distress. He'd look at companies like CMS Energy that were heavily discounted during widespread public fears over nuclear power, or finding deep value during retail panics, like with Pier 1. The whole strategy here is to leverage temporary industry-wide hysteria to your advantage. As Lynch proved, when the market completely lost its mind and panicked, heavily discounted opportunities like Pier 1 and CMS Energy popped up purely because of sheer hysteria. And that begs a massive question for you. When the market crashes, when the headlines are absolutely terrifying and the news is just overwhelmingly bad, what do you see? Do you see a crisis? Or do you see a heavily discounted shopping season? Because the intelligent investor, they see the latter. They see a chance to literally buy $1 for 66 cents. Let's turn to Section 4, the scuttlebutt method, which is all about ground-level investigative research. Okay, once we identify one of these distressed targets in a beaten-down industry, it's time to transition from theory to actually doing the legwork. And honestly, this is where you earn your returns. The scuttlebutt method means totally bypassing the polished corporate fluff. Don't get me wrong, annual reports are great, but they're heavily curated. If you really want to find those uncommon profits, you have to hit the pavement. You go out and interview customers on the high street, you speak to current and former employees to gauge if management actually has integrity, you even talk to their competitors. You are digging for practical, real-world data that those Wall Street analysts sitting comfortably in a New York office are completely missing. And finally, Section 5, discovering economic moats. This is the ultimate prize we're looking for. All of this scuttlebutt research, it's aimed at uncovering one very specific asset, perfectly illustrated by this master blueprint from our source document. It integrates everything we've talked about into one cohesive strategic engine. You've got the Dando framework finding the opportunity at the top, you've got the scuttlebutt method handling the gritty research at the bottom, and anchoring the entire thing right in the middle is the ecosystem moat. So what exactly is this moat? Well, an economic moat is a structural, durable competitive advantage that rival companies simply cannot bridge. No way. It could be massive brand power, it could be low-cost production, or it could be incredibly high switching costs. As a value detective, you're looking for a business that possesses this moat. But, and here's the kicker, because the broader market is busy panicking over short-term news, that moat hasn't actually been priced into the stock yet.
Let's look at how this plays out in the real world. Warren Buffett's legendary investment in Apple is the perfect demonstration of an ecosystem moat. Think about it. It's not just a phone, right? It's this deeply interconnected ecosystem of iPhones, Macs, and Apple Watches. This creates massive switching costs for the consumer. Once you're locked into that ecosystem, it is just highly inconvenient to pack up and leave. And because of that structural barrier, customers keep repeatedly buying new products, completely regardless of price increases. That is a fortress. That's a moat that protects the company's long-term cash flow. I want to leave you with this final provocative thought today. Take a hard look at your own portfolio. Are you holding companies because you've actually done the scuttlebutt research, understood their economic moats, and capitalized on the market's temporary misunderstandings? Or are you kind of just following the fearful crowd, buying whatever happens to be popular out of FOMO? True wealth is out there waiting for those who are willing to roll up their sleeves and do the investigative work. So go out there and start looking for your own blossoms in the desert. Thank you so much for joining me on this explainer, and happy hunting.